This is the Human Action Podcast, where we debunk the economic, political, and even cultural myths of the days. Here's your host, Dr. Bob Murphy.
Hey everybody, welcome back to the Human Action Podcast. Today I am rolling solo, and what I'm going to do is make a case for abolishing the Fed, not the case. I always thought that was presumptuous when people would title their essays or books, The Case for something. So the context here is, as I'm recording later tonight, I am going to be participating in a zero hedge debate against David Beckworth on the issue of should we abolish the Fed. So I'm taking the yes stance and he's saying no. It's not because he's a fan of government intervention in general, but he just thinks that, hey, it's better to reform the Fed. And, I think that's the stance he's going to be taking. But unfortunately, I'm only going to get a short opening statement, and then we're going to get into, the moderator is going to be throwing us questions. The moderator is George Gammon, by the way. So I thought, why don't I take this opportunity for the Human Action Podcast to give a long-winded, I would say comprehensive, case for getting rid of the Fed. And then also this will be good for me to work out the kinks before the debate performance tonight. So by the time you're seeing this, the debate will have already happened. Obviously, we'll include that in the show notes page if you want to go see what happens when these ideas get thrown against someone trying to knock them down. But now that I have the undivided floor here, let me go ahead and present what I think is the truth. Okay, so first of all, in terms of strategy, like rhetorically, what I'm going to do here is first just focus on it would have been better if the Fed were never created. All right, and some of the statistics too later on I'm going to show. It's going to be like looking at the various indicators of economic performance pre-Fed and post-Fed. Okay. Having said that, though, then, I will give a plan for reform. Like, okay, well, geez, given that the Fed exists, how do we get rid of it? But I think it's important to do it in that two-step process. And in other contexts, that would be perfectly reasonable. And the reason I'm saying all this on the front end is I saw some pushback on Twitter/X. I recently asked, I said, hey, especially if you're generally a fan of the free market, but you think that the calls to end the Fed are irresponsible or misguided or whatever, can you explain why? Because presumably that's going to be the demographic that I'm really trying to persuade in the zero hedge debate. If somebody's a fan of AOC or something and they want the Fed to be used to help reduce income inequality, there's no way I'm reaching that person. But again, somebody who would be aghast at the government running or setting oil prices, maybe they do think there's a role for them to set interest rates or what have you. Okay, so I asked, and I did get a lot of feedback along the lines of there's too much depending on the Fed right now. Like it's too much of an integral part of our system, and so just to rip it out without having a really serious plan for what would you replace it with is, would crash the economy, that kind of stuff, right? So that's partly why I'm saying I acknowledge that, but I still think rhetorically, but also just in terms of making a case for anything, the first thing to establish is, would it be better if this thing hadn't come into existence in the first place? And then as a secondary question, you can say, all right, well, are there caveats now because it would be difficult to get rid of it? And so to give you two quick analogies, an obvious one would be something like, you're talking to this woman and she's clearly in an abusive relationship. All right. And, so we're just going through and listing and just, geez, your boyfriend is, he's stealing money from you. He hits you a lot. He's cheating on you like crazy. He's always belittling you. You go through the list and say, it would be better if you had just never hooked up with this guy in the first place. And she can totally agree with that. Now, it's true in some scenarios, it might not just therefore follow. So you should break up with him tomorrow. Like if he's really abusive and stuff, maybe she's worried that no, he might do something. And so that could be, but all right. So that's one. A different example would be, like some of you may remember the movie The Firm, based on a book, where Tom Cruise is this hotshot attorney and ends up working for this firm. And then early on in the movie realizes, oh, wow, this is like a totally mob-connected operation. All right. And so he realizes, talking with his wife and stuff, it would have been better if he had just taken a job somewhere else and never gotten embroiled in this. But now, given that he's intertwined with the mob, it's not obvious. What do you do, right? Instead, like, he doesn't just go in and resign the next day because now he's really in a tough spot. Okay. But even with those analogies, still, if a lot of the public has been led to believe that these are good things, even if we just establish, hey, we can all agree this was a mistake to go down this path, right? Even if some people don't stay on board and say, and therefore let's end the thing as soon as possible. To me, that's a win, right? If we could convince 80% of the American public that it would have been better if the Federal Reserve had never been created in the first place and that the U.S. never had a central bank, even if a lot of them said, yeah, but now given that it has been created, maybe unwinding it would be too costly or something, I would take that in a heartbeat. That would be great. That would be such an advancement over what we have right now in terms of public opinion vis-a-vis the Fed. Okay, so there's all that. But, and so I say, that's why I'm kind of doing this in a two-stage approach, that I'm going to first make the case that the Fed should not, it was brought in under dubious circumstances, and just empirically, it has not performed as well as the pre-Fed regime in terms of money and banking in the United States. And then I will, at the tail end of this episode of the Human Action Podcast, give some thoughts on how could you unwind it without causing too much havoc. Okay. So first of all, let me just speak a bit about how the Fed came to be, because that's an interesting story. And here, reading Rothbard's A Case Against the Fed, I think is the title of the book, is great. And he mixes both. He relies partly just on pure economic theory, like the Austrian theory of the business cycle and so on, but also he gets into a lot of the history. And I remember when I was younger at the time, I didn't understand why he did that. I just wanted him to do like an academic, here's why, in terms of pure theory and so forth, the central bank is not on net a positive institution, and who cares about the particulars of how it came to be historically? And now I see things differently, that I think it is important that there, if nothing else, that gives us some indirect evidence that something's fishy here if the way this thing came to be was through deception and so forth. So let me just read, I'm sure many of you already know about this, but the actual, where the inner circle who first hammered out the details of what would later become the original Federal Reserve Act, which was signed into law, I think December 23rd, 1913, right? So the day before Christmas Eve. And even that right there is an indication that, yeah, they were ramming this thing through when, most people were thinking about Christmas and so on. Like that's not when the public and the press would have a lot of scrutiny, is on December 23rd. So I'm reading from this article. It's called The Meeting at Jekyll Island, November 20th, 1910 through November 30th, 1910. So a 10-day period back in 1910. And the subtitle of this post I'm reading is A Secret Gathering in a Secluded Island off the coast of Georgia in 1910 laid the foundations for the Federal Reserve System. So let me just read a couple paragraphs from this thing. So the opening paragraph. In November 1910, 6 men, Nelson Aldrich, A. Piatt Andrew, Henry Davison, Arthur Shelton, Frank Vanderlip, and Paul Warburg, met at the Jekyll Island Club off the coast of Georgia to write a plan to reform the nation's banking system. The meeting and its purpose were closely guarded secrets, and participants did not admit that the meeting occurred until the 1930s. But the plan written on Jekyll Island laid a foundation for what would eventually be the Federal Reserve System. Okay, and then so it gives some context about what the section's called the need for reform and why these men thought something was wrong with the U.S. monetary and banking system as of 1910. And then there's a section titled The Duck Hunt. By the fall of 1910, Aldrich was persuaded of the necessity of a central bank for the United States. With Congress ready to begin meeting in just a few weeks, Aldrich, most likely at Davison's suggestion, decided to convene a small group to help him synthesize all he had learned and write down a proposal to establish a central bank. The group included Aldrich, his private secretary Arthur Shelton, Davison, Andrew, who by 1910 had been appointed assistant treasury secretary, Frank Vanderlip, president of National City Bank and a former treasury official, and Warburg. And it had earlier established Warburg was a German-born financier connected with the big investment bank, who had been publicly writing about why the U.S. was antiquated and it should have other central banks like, all the civilized nations in the world. And the U.S. was so, out of date in terms of its banking system. A member of the exclusive Jekyll Island Club, most likely J.P. Morgan, arranged for the group to use the club's facilities. All right, so J.P. Morgan was not at this meeting. What they're saying, this was a very exclusive club, so somebody who was a member must have arranged for these people to come and have their meeting there. And it says probably J.P. Morgan was the guy. Founded in 1886, the club's membership boasted elites such as Morgan, Marshall Field, and William Kissam Vanderbilt, the first, whose mansion-sized cottages dotted the island. Munsey's magazine described it in 1904, talking about the Jekyll Island Club, as, quote, the richest, the most exclusive, the most inaccessible club in the world. Aldrich and Davison chose the attendees for their expertise, but Aldrich knew their ties to Wall Street could arouse suspicion about their motives and threaten the bill's political passage. So he went to great lengths to keep the meeting secret, adopting the ruse of a duck hunting trip and instructing the men to come one at a time to a train terminal in New Jersey where they could board his private train car. Once aboard, the men used only first names, Nelson, Harry, Frank, Paul, Piet, and Arthur, to prevent the staff from learning their identities. For decades after, the group referred to themselves as the First Name Club. Okay, so you might be saying, oh, wow, that sounds pretty conspiratorial and provocative and dramatic or whatever. What, are you reading, Bob, from G. Edward Griffin's book, The Creature from Jekyll Island, or, some guy who's definitely a Fed critic and he's trying to... No, this is from the Federal Reserve Bank of St. Louis's official website that they devoted to the Federal Reserve's history. Right, I think it was at the Centennial or something that they established this standalone website called federalreservehistory.org. But it is connected with the Federal Reserve itself. That's their official history. The people they commissioned to talk about the Fed's founding. That's the art. I was just reading from that article. All right, so this is all in the open. So again, remember some key passages there. They didn't even admit that meeting had happened until the 30s. Right, so 20 years after it had happened. And they went to great lengths to make sure the press didn't know it was happening, going so far as to have them go to New Jersey. Why would they go to New Jersey to get, they're not, it's not like they're all hanging out in New Jersey. They're doing that to surreptitiously get on a train with as few people seeing it as possible. And then coming down, and again, only using their first names and saying on the surface, oh, we're just going duck hunting. Because again, why? They knew if the press got wind and it was openly reported that, Aldrich is meeting with all of these, both New York-based and then also foreign financiers and so forth, private interests, to write this bill to create a central bank for the U.S., it's not going to pass. All right, so right out of the gate, they knew they had to use secrecy in order to get this thing through. So that's an indication that, that's a little bit weird. Also, the act as originally passed, it was called the Federal Reserve Act. So what if you think about what reserves, fair enough, you say what that means. But the word federal, why are they calling it federal? In other words, the other central banks of the world are things like the Bank of England or the Banque de France, right? The Bundesbank and so forth, right? Like the other central banks connected to powerful governments around the world, it was just the bank of that country. Okay, whereas in the United States, there had been a history. It was the first Bank of the United States and the second Bank of the United States are considered the precursors to the Fed. Andrew Jackson famously killed the second Bank of the United States. Now, those were not fully fledged central banks in the way that the Bank of England was. All right, I don't have time now to get into that. But even the second Bank of the United States, for example, its notes were not legal tender. All right, just to give one obvious example to show it's not that the second Bank of the United States was just like the Fed, but earlier. Okay. And so, whereas the Federal Reserve was the closest thing, the most powerful type of entity, similar to the central banks that other governments had established, powerful, European governments and so on, British government. But because the American people were skeptical of concentrated power, that's why they called it a Federal Reserve Bank. And originally, there still are, there were 12 Federal Reserve District banks spread out throughout the country, New York and Chicago and so on, but other cities as well. And let me say before I forget, all the stuff I'm talking about here, there's a lot of this that I document in my book for the Mises Institute called Understanding Money Mechanics. Like I go through, it's an interesting story. Like how did they determine which cities would be Federal Reserve district cities? Okay, and there was a process, various cities were jockeying for that. There were obvious ones, like obviously it's going to be in New York and Chicago, but beyond that, there was some discretion. So anyway, I document a lot of that stuff in my book, Understanding Money Mechanics, the Mises Institute has for free. If you go check it out. The PDF, I'm saying. But in any event, those Federal Reserve District banks independently set their monetary policy. Okay, actually, they probably didn't even think of it as monetary policy. They just viewed it as, the bank is running its operations just like other banks do, and we buy assets and we make loans and so forth, and do things that banks do. It's just we have certain privileges and also formal responsibilities as part of our status or position in the system. Okay, but the Fed did not operate as a unified entity. That consolidation would come via the 1935 Banking Act, right? That would happen, in the midst of the Great Depression under the Roosevelt administration. And so let me just talk about three important changes that occurred. So again, the initial Federal Reserve Act is in late 1913. The Fed, launches in 1914. And then there is a major reorganization of the Fed's operation and structure in the Banking Act of 1935. So, for one thing, the Board of Governors, which was in D.C., the power was consolidated there in terms of Fed decision-making authority, and they even changed the titles. That originally, the head of each of the Federal Reserve District banks was called a governor, because in the banking world, governor is the most prestigious title. If you're the governor of a bank, that means you're in charge. And they renamed him to president, right? So if you're not in that world, you might say, oh, isn't the president the head of the company? But that's in the banking world, that was a demotion, right? So again, by having the Board of Governors in D.C., whereas the heads of the 12 district banks were now just the president of the Federal Reserve Bank of Chicago and so forth, that was a demotion that signified that you don't have as much power as you used to. Originally, in terms of, who would sit on that Board of Governors, originally, the original Federal Reserve Act, the Secretary of the Treasury was the chairman of the Federal Reserve. And then that was no longer the case after this change in 1935. And the comptroller of the currency was also always going to be a member on the board up until this reorganization. All right, so there's a twofold thing that the Banking Act of 1935 did. First, it consolidated power away from the district banks and concentrated it, but also it made the Fed itself more autonomous from the federal government. Right, so there was a twofold thing there. And another major development was that the Fed's operations were all unified and major decisions were made by the Federal Open Market Committee, again, now focused in Washington. Oh, another thing, too, is the Fed's meetings, like the Board of Governors, that used to be held in the Treasury Department. Right, when the Fed was originally founded, again, the Secretary of the Treasury was like the head of the Federal Reserve System, and the meetings were held in the Treasury Department's buildings or offices, and then part of this 1935 Act, they moved to a different location. And then last thing I'll mention is this reorganization in 1935 also ushered in the fact that now the Fed's operations were more systematic and unified. And so you could speak of the Fed now buying assets or, setting interest rates or whatever. And that was all, again, signed off on or coordinated through the Federal Open Market Committee, which was concentrated in Washington. And the operations were all carried out through the Federal Reserve Bank in New York and, its operations on Wall Street. Okay, so just to give you one example of this, when I was writing my book on the Great Depression, I wanted to test the hypothesis or the common claim that, the reason the 1930s were so bad is because the Fed was really tight, right? Like that's Milton Friedman and Anna Schwartz's revisionism, is they had come along and say, the Fed caused the Great Depression all right because it didn't inflate enough in the early 1930s. There were all these bank runs and the Fed should have inflated it instead it had too tight of a monetary policy. And I wanted to show, well, no, the Fed had been way tighter in the 1920 and 21 depression, right? And so I was using statistics about, the Fed's asset holdings and things. And one of the things I wanted to look at were interest rates and to say that actually in the early 1930s, the Fed cut interest rate down to record low levels, whereas in 1920 and 21, it jacked up interest rates to what at that time were record high levels. So again, the point is, I was trying to explain why the 1930s turned into a decade-long depression. It doesn't make sense to say, because at the start, the Fed was stingy and too tight. That no, by various metrics, the Fed was extremely loose. I said where it was tight was in the 1920 and 21 depression. And notice it's called the 1920 to 21 depression. It's not called the Great Depression of the 1920s, okay? But my point is, why I'm going off this little tangent here, is in order to make that case, I realized, so I could go look at what the Fed charged the discount window or whatever, certainly, in the later 30s and whatnot. But I ran into this issue of even in the early 30s and certainly in 1920 and 21, even though the Fed existed back then, right, because the Fed was founded in late 1913, you couldn't just go look up and say, what was the Fed's discount rate in 1920 and 21? And how did that compare to 1919? Because there wasn't such a thing. It was each of the 12 district banks had their own policies. So I think what I did in practice was just look at the New York Fed and compare what its policies were in 1920, compared to 1919, and then at 1930, 31 compared to 1928, that kind of stuff. Okay, so that's what I ended up doing. But my point was just, it drove home to me that, it doesn't even make sense to say, what was the Fed doing in 1920? You can't speak like that. It's because they were distinct entities, and each governor of each district bank was in charge of, the policies of that particular Federal Reserve Bank. Again, that's why they called it the Federal Reserve, to reassure Americans who were very skeptical of consolidated banking power that, we're not having this concentrated behemoth the way that the British and the French and the Germans have. We have a federal system. Okay, so again, so partly why I'm going all through that is this isn't just me talking. Conventional historians and monetary historians would admit that back in 1913, if Aldrich and his supporters had tried to push through a Federal Reserve Act that had the features of what the Fed would become in 1935, it almost certainly would. Well, maybe they wouldn't say almost certainly, but it would have been harder to get that thing through. Okay, and I think it wouldn't have passed, but maybe there's difference of opinion. But the point is clearly they didn't try to push that in 1913. They said, no, this is a system of 12 independent banks. They can set their own policies. It's a federal system. Okay. So again, partly I'm going through this to show the Fed was originally brought in through secrecy. They kept hidden the kind of people that contributed to this act because they knew it wouldn't pass. And then the system they actually developed was changed in 1935 more to the current structure, and it never would have gotten its foot in the door, I claim, if it had been, in its current version up front. So all this is to show that us getting this more modern version of the Fed would not have happened originally, that it was done through secrecy and then changing the rules during a crisis that the Fed caused or greatly exacerbated, ironically. Okay, so let's now just look at some measures of economic performance. So so one thing is, let me say this. What I'm going to be drawing on here is a paper by George Selgin, Larry White, and William Lestraps, approaching the centennial of the Fed. They wrote this 100-year report card, and I want to stress this is not some libertarian ideological. Oh, we don't like the Fed because fiat money's bad or something. They got a version of this paper, a more academic-y version, published in the Journal of Macroeconomics. All right, so this has all the bells and whistles and the underlying sources they relied on for some of the empirical work or reports or claims they make in the paper is not coming from laissez-faire bomb throwers. It's coming from people like Christina Romer and so forth. Okay, so just to be clear that this is a very respectable academic peer-reviewed paper that you don't need to be embarrassed about to show to your mainstream economic friends, if you have such friends. All right, so one statistic you could use is like the dollar's purchasing power. All right, and so looking from before the Fed's creation over very long stretches, the dollar basically maintained its purchasing power. Okay, that that was, of course, because we were on a gold and or silver standard, depending on how far back you go. And that's just a natural inbuilt tendency that when, the dollar for long stretches of U.S. history was literally defined as a certain weight of gold and or silver. Again, if this stuff interests you, but you actually never saw it spelled out, I strongly encourage you, because I learned a lot writing the book Understanding Money Mechanics from the Mises Institute, because this was always something that I was interested in, and I never saw it spelled out. One last thing I'll give for that, just to make sure. I used to think that the federal government always issued paper notes that were, dollar bills and $50 bills and $100 bills. And it's just that, before 1971, you could turn them in and get a certain amount of gold. And then I knew silver was involved too, but I didn't quite understand how that was back in the day. And no, when we say the dollar was gold and silver originally, it was much stronger than that, right? Originally, the federal government, from the founding, after the Constitution was formed up through the eve of the Civil War, the federal government did not issue any paper notes that were official U.S. dollars. All right, I think there was like a borderline in the War of 1812 or something where they had treasury notes but they bore interest and they weren't legal tender. All right, but other than that, so it was not that Americans were walking around with paper notes that said, $10 US on them that the federal government printed. That was not the case before the Civil War. The official money of the U.S. were gold and silver coins of certain defined weights. Like you could have a $10 gold eagle coin or a $20 double eagle, or you could have a $1 silver coin or a $quarter silver coin, or just a quarter for short, 25 cents, right? So that's what the money was, the actual, the legal official money issued by the government. And then paper notes were issued by banks, but those were not the same thing, right? A $10 note from a bank was ultimately the reason that would circulate in normal times at par with the gold and silver was that you would know, I can go to the bank and turn this in and they will give me a gold eagle $10 coin if I want. And so that's why, for convenience and so on, those notes would circulate. But if there was a financial crisis, the notes wouldn't circulate at par, right? And people would turn them in and want to get actual money. Okay. And again, and there weren't legal tender laws, right? So if you owed someone a debt of $100 and you tried to pay them with banknotes, they could say, I'm not taking that. Give me gold and silver official coins. They might in practice take it because if they thought it was fine and they were going to go spend it. But if you couldn't just say, no, I gave them, I owed them $100 and I gave them $10 notes from this bank. And so my debt's free and clear. No, they could say, no, you didn't. All right. This is not valid legal tender for the settlement of debts. Okay. So in any event, what I'm saying is during that stretch before the Fed, when the U.S. was still on the classical gold standard, the dollar maintained its purchasing power over long stretches. So like what $100 would buy you in the year 1800 was roughly what $100 would buy you in terms of goods and services in the year 1900. Okay. There were periods where there could be what we would just call inflation, right? Particularly during wars, like during the Civil War, most famously, that the dollar's purchasing power would go down, meaning the prices of goods and services measured in dollars would go up. But then because the authorities, like even after the Civil War, they had suspended what's called specie payment, right? And the Union famously issued what are called greenbacks. So that's when the federal government did start printing money, literally, to pay for the war effort. And they suspended specie payment. Specie means like the hard metal money. Okay. So the dollar technically was not officially convertible into gold and silver coins during that stretch. But then they did pass legislation, I think such that by 1879, they had restored convertibility to gold. Okay. So my point is what you saw, if the dollar maintained its purchasing power vis-a-vis goods and services over long stretches, and even if you did have periods where it might lose its purchasing power because the dollar was strictly tied to gold and silver for a stretch before it was demonetized in 1873. You may have heard of the crime of 73. That's what they're talking about, that the free coinage of silver was ended in that year. Again, this is all spelled out in my book if you're interested in this stuff. Because of that, you could have periods like during a war where, there was price inflation, prices went up, but then there would be deflation following that. And so that the purchasing strength of the dollar would eventually be brought back to its normal level. Okay, and the intuition is it's because if the production of goods and services outstrips the stock of money, then people could, they can just mine more gold or silver and turn it in and create them and turn them into coins and go spend stuff, right? And so there would be monetary inflation, that the money stock would get expanded. Okay, but then vice versa, if they created too much, if banks issued too much paper or whatever, people would turn that in and get the gold and silver, and the banks would have to stop. All right, unless they run out of gold and silver in the vaults. Okay, so there was these natural inbuilt mechanisms to keep the purchasing power of the dollar stable over long stretches. All right, I don't think I even need to tell you from 1913 onward, did the dollar retain its purchasing power? No, of course not. Now, in fairness, so you can see statistics. I'm sure you've heard like Ron Paul and other people say things like since 1913, depending on when you're making the claim, the dollar has lost 99%, or, later it would be even more, 99.9% or what have you of its value. All right. So something that cost $100 in 1913 would cost a lot more than $100 in 2025, or the other way around, like the amount of goods and services you could have purchased for $100 back in 1913, now for $100, what could you buy compared to that? Things like that. All right. So it's clear that it's not even close. If that's the metric we're going to use, is the preservation of the purchasing power of the dollar. Now, in fairness, some of that you could say, well, it has more to do with the gold standard than the Fed, and that is true. In other words, if you look at the fall in the purchasing power of the dollar, a lot of it happened since 1971. But it's not merely that. It's not that the dollar between 1913 and 1971 maintained its purchasing power. That's not the case. All right. Now, what's interesting, and that they spell out in the Selgin et al. Paper, is you might say, okay, sure, the dollar roughly kept its purchasing power before the Fed, and after the Fed, there's been rampant price inflation, so the dollar's become weaker. But, what people can adjust to that, right? Like, people know nowadays you'd be silly to take cash and put it under your mattress, or to, keep $100 bills in a home safe. People don't do. They go invest it and whatever. So, and as long as people kind of understand that there's going to be inflation, they can build that into their contracts or whatever. They sign when they take out a mortgage, or they sign contracts with their employer. They can have cost of living adjustments and things like, so when people lend money, they take into account the fact that, the money I'm getting paid back with is going to have lower purchasing power, right? So as long as everybody adjusts to this new reality, that's fine in terms of economic planning and coordination. Even on its own terms, I disagree with that because it makes it sound like an actual counterfeiter wouldn't be hurting the community so long as everybody anticipated what would happen. And that can't be right. Right? If you found out some guy down the street was laser printing $100 bills in his basement and they were indistinguishable from the real thing, and he's living in a mansion and he's got all kinds of fancy cars, and you realize it's because he's just cranking $100 bills, there's definitely a sense in which he's stealing from the rest of the community. If someone wanted to say, hey, the authorities should arrest that guy because he's a counterfeiter, and you say, well, why? Who's he hurting? That would be the obvious thing. Well, yeah, you see all those cars in the mansion and stuff there? He's siphoning those real resources away from the rest of us. And it would be kind of goofy to say, well, no, but as long as, we take into account the fact that prices are higher than they otherwise would have been, as long as we just build that into our expectations, we kind of offset what he does. That would be goofy. No, if he has more cars and houses because he's printing money in his basement, counterfeit money, that those are cars, and, maybe not the exact cars. Maybe that's the steel and the rubber would have gone to something else, but clearly the real resources getting channeled into his consumption, his lifestyle, is taken from the rest of society, right? And so I would say the same thing with the Federal Reserve. Even if you want to say, as long as people build into their expectations the fact that consumer prices are going to rise by 2% every year on average, then it's totally offset. No, it's actually not. But put that aside. On its own terms, and this is the point that Selgin et al. Made in their paper that was interesting. If you look and say, okay, what's the volatility of consumer price inflation annually, let's say, then it is true, at least according to some ways of crunching the numbers, that in the pre-Fed era, that the annual volatility of consumer price inflation is higher than in the post-Fed era. Okay, so if you wanted to just say, hey, make your best guess about what the rate of consumer price inflation is going to be from some randomly selected year in the sample period of, you can even do a post-Civil War, like certainly if you did it pre-Civil War, right, like 1793 to 1913, just pick a year at random. What do you think the price inflation rate is going to be that year? And then you say, now do it from 1913 to, they had it up through 2009, by the way, in Selgin's paper, in terms of when it was published, the data set stopped at 2009. Instead, do it from 1914 to 2009, pick a year at random. What do you think the inflation rate in terms of consumer prices is going to be? It's true. For you to be 95% sure that the actual number would be in the range that you give, you could give a tighter window or band for the post-Fed period. Okay, so in that sense, it is true that the annual rate of consumer price inflation was less volatile or more predictable post-1913 than pre-1913. However, pre-1913, statistically the process of the year-to-year inflation rate was, I don't know if mean reverting is exactly the right word, but if there were periods where you had high price inflation, you knew it was more likely that in the near future you were going to have price deflation, or at least lower price inflation. Whereas in the post-1913 period, and then I think especially like after 1971, the year-to-year inflation rate was more of what's called a random walk. So that, if price inflation in some year was 5%, then in the next year, your best guess as to what it would be you'd say 5% again, or maybe add a little bit or something, right? But whereas again, in the pre-Fed era, if you picked a random year and said, consumer prices rose 5% that year, then you'd say, so probably if I have to now guess what's price inflation going to be in the following year, you would say it's going to be less than 5, and it might even be negative, right? And certainly if you did like a few years ahead of time and say, what's the average inflation going to be over the next 5 years in the pre-Fed era, if I told you that, the inflation rate was 5%, then you would be pretty sure over the following 5 years it was going to be a low number, if not negative, whereas in the post-Fed era, that wouldn't necessarily be the case. All right, so what's the point? Who cares? The point is, in the pre-Fed era, if instead of saying, what do you think the year-to-year change in consumer prices is going to be? What if you don't ask that question? What if instead you say, what do you think the price level is going to be? Putting aside the caveats of Austrian concerns about that concept, but you get the idea. Just generally speaking, what's the level of the prices of goods and services? That was much more predictable in the pre-Fed era than in the post-Fed era. Okay? And so, because again, what's going on here is in the pre-Fed era, if you had a burst of higher, of positive price inflation because of the strict tie to gold and or silver, that meant, prices are now going to start dropping again to bring the purchasing power of money back to its stable long-run level, right? And so over long stretches of time, you can say, whatever $100 bought you at the beginning of the period, look 50, 75 years in the future, $100 will probably buy you roughly the same amount of goods and services if you had to guess. In practice, it might be off a little bit one way or the other, but if you had to guess, you'd say it. Whereas in the post-Fed era, if you say, what's $100 going to buy me in 1960, and then you say, now look 20, 30 years in the future, what's that $100 going to buy me? You know it's going to be a lot less, but also you're not as confident of how much less it's going to be. If you just had to guess, you weren't sure the exact timestamp, right? So that's what I'm trying to get at is that yes, if you see some pro-Fed analyses trying to show that, look, the predictability of inflation improved with the Fed, and in their forward guidance and blah 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 blah. Okay, but that's coming at the cost of that the predictability of the future price level or the purchasing power of money became less predictable. All right, and that's really, if you think about it, what's surely more relevant for long-term business plans. It's not so much that you need, if you're going to lend money for 20 years, it's not so much that you care what's the predictability, how sure am I of what CPI changes are going to be like in year 18 and then in year 19. No, you care much more about when this loan gets paid back, what's the purchasing power of money in that year going to be compared to today? That's the kind of calculation. In other words, the reason you would care about the year-to-year changes in the price level or inflation rates is so that you could then do a cumulative calculation and figure out what's the purchasing power of money going to be, right now when I'm lending it or investing it if you're, investing in an enterprise versus when I'm going to get my returns. That's why you would care about the year-to-year CPI rate. And so if that's really the metric that's important, then it's obvious that the pre-Fed era vastly outperforms the post-Fed era. And again, this isn't simply a matter of like going back to the counterfeiting analogy. I'm not merely saying that, so like the amount of theft, as it were, or redistribution of real resources to the politically connected people is lower when the purchasing power is maintained, even though that is a true separate statement. But I'm saying just in terms of the monetary framework and giving predictability, that's surely something, other things equal, you would want your monetary and banking system to yield, to make it so that business people and investors are more comfortable with having long-term horizons, and they're not investing just in short-term operations simply because they say, I don't know what the money's going to, what the purchasing power of the money is going to be 10 years out. There used to be things like 99-year bonds in the 1800s in the U.S. And then obviously that's, you'd be crazy right now to lend your money for 99 years. Why would you do that? Who the heck knows what you're going to get paid back with, right? The British government used to have consols, CONSOL, which were perpetual non-maturing loans, right? You would just buy a bond from the British government and it would just pay interest forever and it would never mature. Okay. Like, back in the day. And that was because people had very long-term horizons. They thought, well, no, as long as the pound is tied to gold, what do I care? It's very dependable. And they don't do that now. Okay. What about output? So here, in terms of, again, we're assessing the Fed, the volatility of output, pre-Fed, post-Fed. Just big picture, clearly everybody agrees the worst economic crisis to hit the United States was the Great Depression. When did that happen? Well, the stock market crash was in 29 and the Great Depression's in full swing through the early 1930s. And most people would say, the entire 1930s. And a lot of people think, oh yeah, and then World War II got us out of it, right? Some of those claims are dubious, but the big picture is certainly right that the Great Depression was the worst calamity that struck the U.S., and it was in the 1930s. When was the Fed founded? Late 1913. All right. So the Fed was in operation for a good 15, 16 years before the Great Depression happened. So that's clearly on the Fed's watch. There's no way you can get around that. What was the second worst calamity that hits the U.S.? Arguably, it was what's called the Great Recession, the financial crisis in 2008. Again, on the Fed's watch. And that one's interesting because earlier, Ben Bernanke he was given a tribute to Milton Friedman at some event. This was before Bernanke was chair of the Fed. And he said he was praising Milton Friedman for his work with Anna Schwartz on figuring out that, it was misguided monetary policy that made the Great Depression into what it was. That was Friedman's hypothesis in his monetary history book. And so Bernanke said in the early 2000s, I forget the exact year, I think it was like a birthday party or something for Milton Friedman. And he said something like, yes, if I can slightly abuse my position as he was some member of the Fed, but not the chairman at that time. And Bernanke said, if I can slightly abuse my position here, let me say on behalf of the Federal Reserve, you're right, we did it, meaning we caused the Great Depression. He said, but thanks to your work, it won't happen again. And then on the Fed's watch, it's not that the Fed was disbanded in 2005, and that's why we got the financial crisis in 2008. That's not what happened, right? The Fed was in charge, and they were patting themselves on the back that, oh yeah, good thing now we've figured out how to, eliminate bad economic crises thanks to our academic work. No, that's not what happened. All right. So just, again, prima facie, obvious history, the two worst economic calamities in U.S. history clearly happened on the Fed's watch. Now, what's interesting, and again, in the Selgin paper, they point this out. So here, we'll flash it up on the screen. Which may surprise you is that even using a statistical analysis, and again, this is not from, some paper put out by the Rothbard Institute or something. They're relying on. So what this paper is showing is output volatility measured as a percentage standard deviation from trend using different estimates of GNP. All right, so going back historically, they use GNP, gross national product, not gross domestic product. And so that's why, these historical estimates are the ones that they're relying on. So the series, they're using the specific time periods I'm showing here in this chart. The first column is showing output volatility from the period of 1869 through 1914, right? So that's going back. They have decent data to say what was GNP in 1869, 1870, and so on, so they can get a sense of what's the trend and then say deviations from trend, okay? So again, the numbers in this table represent volatility. So the bigger the number, the more volatile economic growth was or output was in these periods. Okay, so you see column 1 is 1869 to 1914, so that's a measure of the pre-Fed era. And then the second column is 1915 through 2009. Okay, again, because this paper came out in 2012, right? So that's their data set ended at 2009. That's why they stopped there. So it's including, the big drop in output due to the financial crisis. Okay, so that first row there, the standard, that's saying this is using the standard historical measures of GNP. The second row there is from Romer, who had an alternate series. Okay, and it's not worth getting into here, but Romer, one of the issues is it used to be the case in terms of the standard measures of GNP fluctuations in the 1800s, they didn't have great data on the prices. So they had data on like the absolute movements in total spending, right? So like what we would call nominal GNP, but what you care about is movements in real output. So price adjusted or inflation adjusted GNP. And so to do that, you need to know, well, how much did prices change? And so the problem is they have much better data, later on than they did for the 1880 in terms of what was the price level change. And so what they do have good data on, though, is things like commodity prices. And so the standard measures do things like they would just assume that, changes in commodity prices are a good proxy for changes in the overall price of goods in general. But that's actually not correct. That especially during economic crises, commodity prices swing a lot more than prices in general, especially, prices of goods and services for consumers. And so that's one of the things that Romer does, is to try to come up with a more accurate measure of changes in price, the price level. And then that means the swings in real GNP are smaller historically than what the standard estimates showed, right? So that's just one example. So anyway, just cut to the chase here. It's funny. It's standard in this literature when people are assessing the Fed, a lot of the pro-Fed people will just naturally compare the pre-Fed era to the post-World War II era. Now, in fairness, that's partly because we have much better data, right? That the federal government greatly expanded during the World War II, and then afterward, they had all kinds of statistical bureaus and bean counters and stuff in place. And so we have a lot better data. That's why if you go, looking up various historical data for the U.S., a lot of it starts either in 46 or 47, because that's when, really good collection of various indices and so forth began. So that's why we have, that's why it does that. So, but also on this type of question to assess, has the Fed contributed to economic stability? It's kind of stacking the deck to say, well, let's start measuring the Fed in 1947, right? Because it's like, if you let them take a mulligan on the Great Depression, okay. So what's interesting, though, is you see the ratio of 2-to-1, that column that I've highlighted, that is showing the performance, the volatility of the entire Fed period versus the pre-Fed period. So if this number is bigger than 1, it means the Fed had more volatile output than the non-Fed era. And so you see for both the standard measures, the Romer, and then also the bulky Gordon one, which I'm not as familiar with, that number's bigger than 1, meaning looking at the full sample period, the entire history of the Fed's performance, everybody agrees, all the data sets agree, economic output was more volatile with the Fed than it had been before the Fed. All right. And then what's interesting, if you look at the ratio of 4-to-1, that's saying even if we throw out the Great Depression and World War II, and just look at the Fed's performance from 1947 through 2009, even there, under the standard measure, the Fed is like half as volatile as the pre-Fed era, right? That's what that 0.504 means. But if you look at the Romer estimates, there's only roughly a 4% improvement, right? That the volatility of the Fed post-World War II is 0.959 of what the volatility of economic output was in the pre-Fed era. Okay, so my point in going through all this is just to show that using standard analysis, it is not at all the case that, the statistics show that the Fed contributed to economic stability, and it's just, you have to go to some cranks, people who have an ideological axe to grind. No, just the normal standard numbers show that the Fed made economic output more volatile. All right, so it certainly hurt the purchasing power of the dollar. It made future price levels less predictable, and it increased economic volatility using standard data. So that's the sense in which I'm saying clearly. And if you go look at, what's the rationale? What is the Fed supposed to be doing? Those are some of the things, supposed to be contributing to a stable purchasing power and reducing economic fluctuations in terms of the part of the dual mandate that they gave when they revised the Fed's mission in the 70s. And certainly in the original founding, it was in response to the panic of 1907. The point of the Fed was to come in and provide what was called an elastic currency to ease financial crises and so on. So again, under its own stated objectives, the Fed made things worse. And so that's why I was saying that, if that's what we're going to do, I think I'm clearly establishing the Fed made things worse. Okay. Now, let me mention on this issue of lender of last resort, what's interesting here is the Fed in practice isn't even doing a good job on that score, right? So during the financial crisis, I'm looking at the clock here. I'll try to wrap things up quickly. During the financial crisis, the Fed was buying so-called toxic assets, and it also began paying interest on reserves. All right, so it shouldn't have been doing either of those things if it were following classical central bank doctrine of how do you act responsibly as a lender of last resort. All right, so there's this famous thing Walter Bagehot was writing, trying to give guidance for the Bank of England and just summarizing, what good central banking practice was in the 1800s. And he had this famous rule of, I don't know if this is the exact quote, but that in a crisis, the job of the central bank is to lend freely to solvent but illiquid firms at a high rate of discount. All right? And so that's kind of what people summarize as the lender of last resort function. So the idea was if you had institutions that were solvent, meaning their assets were higher than their liabilities, but they were illiquid, meaning they had a cash crunch, but no, they were good. If they could just find someone who would be willing to lend to them to get them through the pinch, and then things would be fine, that's what the central bank was supposed to do. But it was not supposed to. If there was some organization, they had just been running, they were mismanaged and they were insolvent, that their liabilities were higher than their assets, the central bank wasn't supposed to lend to them to keep them afloat. They should go down, right? And that's partly what the dictum was, is to lend freely, meaning, go ahead and be willing to open up the spigots of lending, but at a high rate of discount, a penalty rate, meaning, lend, but at a higher rate than would be the case during normal times, and to really separate the wheat from the chaff, to show that, only those institutions that they are fundamentally sound and they just hit a cash crunch and they just need to borrow money temporarily to get them through this crisis, and then they're going to pay us back and go back to their normal business model. That was the function of lending freely, but at a high rate of discount. So during the crisis, financial crisis in particular, the Fed doesn't do that. They're lending at rock bottom rates, and they're buying things that had been called toxic assets, right? That's not what you're supposed to be doing. And then again, the other thing I mentioned is they started paying interest on excess reserves, which if part of what you're doing is you're trying to restore the flow of credit and to keep lending going in the economy, the last thing in the world you would want to do is have the Fed pay banks to stop making loans to their own customers. But yet that's what paying interest on reserves means, right? That the Fed said to its member banks, if you keep your reserves parked with us, before they paid them 0%. And in, I think it was October of 2008, the Fed inaugurated this new policy where we're going to start paying interest. If you keep your reserves parked here, we will pay you interest on it. It was low at the beginning. It was like 25 basis points or something. But that was a new policy, and they instituted it right at the time when a lot of more conventional monetary economists were saying, oh yeah, with this crisis, the Fed needs to reassure everybody there's liquidity in the system, and we want to make sure that, we got to bail out Wall Street, but that's just to keep credit flowing to Main Street. Like that was some of the slogans that were issued. So if that's what the Fed was doing, why would they start paying banks to not make loans to their customers? And yes, that's what they did. So to me, there's no mystery here. The explanation is the Fed existed to bail out the banks. It wasn't there to stabilize the economy or the credit markets. Okay. And this kind of goes to the problem with the Fed as it currently exists. So as an Austro-libertarian, I think the best thing would be the complete freedom and private money in banking. Don't have the government involved in any way, just like the government's not involved in pizza production. It shouldn't be involved in money or banking. If you're going to say there's got to be a night watchman state with regulations on business and contract enforcement, okay, but then just do that for banks and institutions that take gold and silver and stamp them into coins, just standard, whatever they say they're going to do with their customers and whatever contracts they have, just enforce that. Okay. That's the first best thing. A second best thing would be, okay, if you're insisting that the government is involved in producing money and acting as a lender of last resort in crisis and stuff, okay, but then you want to have that under strict safeguards and public accountability and transparency, so we know who they're bailing out or what they're doing, what the policies are, and just to try to root out corruption, at least keep a tab on it. And then if something goes wrong, we know who did it and who's responsible. All right. What we actually have is the worst of both worlds. We have this hybrid system where the Fed is this quasi-private organization. It is literally owned by private banks. Private banks are shareholders in the Federal Reserve, and they receive dividend payments as part of being part of the Federal Reserve System. And the Fed, people celebrate its ostensible independence from the federal government, where the Fed can go do whatever policies it wants, and people are outraged, like when President Trump suggests that Powell should cut interest rates. People lose their minds, right? Imagine if the FDA were literally owned by the pharmaceutical companies, right? And we could say in practice, there is this cozy relationship and there's this revolving door. But imagine if it were literally, if the pharmaceutical companies own shares of stock in the FDA, and also the FDA's leadership board consisted of people moving in and out. I mean, that it would just be one level more naked than, the corruption that we think exists right now anyway. Right? I'm saying that's what the Fed is right now. Another anecdote here is in December of 2008. So this, the financial crisis hits in like September-ish, in full swing in October. There's the TARP bailouts and all this stuff. And the Federal Reserve had initiated all of these, what they called extraordinary programs, like opening up new facilities to allow like the big investment banks and whatever that were really in trouble because they were sitting on mortgage-backed securities and other things, to allow them to stay afloat, where the Fed was just doing all sorts of extraordinary lending and just rolling over stuff very rapidly. And so in December of 2008, Bernanke goes to testify before Congress, some subcommittee or whatever, and they asked him, and they said, "Look, you've got this new program in place, and you've got hundreds of billions of dollars coming and going to all of these financial institutions. We're not second guessing your decisions or anything, but can you at least tell us who you're lending this money to? Right? We just want to know, like, who's getting all these hundreds of billions of dollars you're talking about, because that was secret. You didn't know. And Bernanke actually said to them, well, no, I can't tell you that, because if the public knew that some particular institution had to come to us and take like a short-term loan of $1 billion, then the public would think there was something wrong with them and they would pull their money out, and then that institution would go down. And he said, so it defeats the entire purpose of our extraordinary liquidity programs if I were to tell you who's taking advantage of them. And so, again, it was just showing that it's not just that the Fed was given billions of dollars to bankers who had miscalculated and were caught with their pants down when the crisis hit, but it wasn't even telling Congress who these people were. And it turned out later that we found out, like, some of them were even foreign banks, right? So the Fed was creating boatloads of new money in order to rescue foreign banks. All right. So, and just again, I'm showing this hybrid system where you have the worst of both worlds, where the Fed has all these privileges and prerogatives. They can create legal tender money just by buying assets electronically. That money, the reserves that are pumped into the system, are as legally valid as $100 bills. Those are Federal Reserve notes. And yet they don't even have to tell Congress who they're shoveling billions of dollars to in short-term lending, right? So that's a weird, corrupt system. Okay, very quickly, how would you get rid of this? How would you reform it? There's nothing magical about this particular proposal. I think, what's really solid is the case that it would have been better if the Fed had never been created. And now, okay, well, if we want to get rid of it, what do we do? There's lots of different possibilities. This is just one example to show this could be done. All right, so one thing to stress is, remember, the U.S. dollar is not the same thing as the Federal Reserve, right? And that's how Ron Paul starts his book on ending the Fed, is he reminds people, don't think of it as, well, gee, if you like dollars, you got to have the Fed, right? Because it's a Federal Reserve. No, well, the U.S. dollar existed in 1912. Americans used dollars in 1912, and the Fed wasn't created until the end of 1913, right? So clearly, Americans can have an economy with strong, robust economic growth using dollars, getting paid in dollars, having bank accounts denominated in dollars, writing checks, so forth, have Wall Street and whatever. That can all happen. The U.S. can be a global player in the world economy, a strong member of the financial sector of the world, without there being a central bank, because that's how it was as of 1912, and nobody doubts that the U.S. was a vibrant member of the global economic community as of 1912, using dollars. Okay, so specifically, what you could do is wind down the Fed, and the issue is, right now, commercial banks issue a lot of what people think of as the day-to-day money electronically, right? So when you think you have $815 in your checking account, that's not directly run by the Fed. That's just your bank is saying, this is what we owe you, all right? And famously, a lot of that money is not backed up by $100 Federal Reserve notes in your commercial bank's vaults. A lot of that is just the bank's internal bookkeeping. So you could get rid of the Fed without messing with that system initially, right? So we're doing baby steps here. And so what would change, though, is you had to say the commercial investment banks who have accounts with the Fed and they have reserves, and then also these notes that say Federal Reserve note on that, what happens to that if the Fed goes away? So there, I think what you could do in the immediate term is just switch so that the Treasury now resumes its function as the issuer, of the U.S. dollar, and those Federal Reserve notes could just revert to being like U.S. notes, and they could replace them, and all the reserves of the assets and liabilities of the Fed could be transferred to the Treasury up front, and then the Fed is just disbanded, and then I would say go back to a gold standard. And Mises, I'll link to the show notes page here. Mises has a very interesting proposal for how the U.S. could tie the dollar back to gold. And so what's interesting is you don't need to, there's nothing arbitrary about it. You just need to pick and say, well, what should the dollar price be? You just use the market price. And then also you can say, yeah, but if you wanted to get to 100% backing, wouldn't that involve massive deflation right now, right? Because there's so many dollars that have been created, even Federal Reserve notes and whatever, way outstripping the gold stockpile of the authorities, even if they have what they say they have, and some people think they don't. And Mises had a great solution that, again, I'll link in the show notes page. I wrote it up for Mises.org, where you say, okay, we just announce what this new policy is. This is, for going forward. I'm just looking up what the price of gold is right now as I'm saying this. Okay, so right now gold is $33.25, let's say an ounce. So the authorities just say, hey, starting next month, whatever the market, the average market price is for that week, we're going to lock that in. And that is going forward. That is the official US dollar price of gold. And we just lock that in, right? The reason you give some time is because the transition to the new regime might cause the dollar price of gold to go one way or the other, depending on how people react, right? So you don't want to just lock in today's price and shock everybody, because that might end up being the wrong price. So you want to make the announcement for the near term, let people adjust, see what that does to the price, the market price of gold, and then lock that in, okay? And then you just say going forward, so now the things have been shifted over to the Treasury. If banks before had reserve balances with the Fed and now they're with the Treasury, if they want to get currency, which would now be U.S. notes, not Federal Reserve notes, they can just go and withdraw that and they'll print it up. Okay, but the Treasury is not going to buy more assets to expand the stockpile of what's now the base money unless people go and deliver the appropriate amount of gold. Okay, so the idea is going forward, the creation of new high-powered money or base money or M0, whatever terminology you want to use, like reserves that the banks hold with the Treasury and green pieces of paper that now are going to be called U.S. notes instead of Federal Reserve notes. The stockpile of that going forward will only increase if people go and bring, let's say it's $3,400 an ounce. Let's say what the new prices that they lock in. So you have to bring an ounce of gold, deposit it with the Treasury, and they put it in a vault and then issue you either, a credit of $3,400 that now, is electronically you owe them, or just print up U.S. notes totaling $3,400 in face value and give it to you. So that going forward, the expansion of that base money is backed up 100% by gold. And so over time, the proportion of the outstanding stock of dollars more and more is backed up by gold. That was Mises' idea, which I thought was brilliant. Okay, so you could do something like that. All right, well, obviously there are a lot of other loose ends we could cover. I've already gone long. Thanks, everybody. And in conclusion, let me just say, and the Fed.
Check back next week for a new episode of the Human Action Podcast. In the meantime, you can find more content like this on Mises.org.